Welcome to our latest explainer. Today, we are diving deep into an anonymous expert report to uncover exactly how high-income earners legally offset their active tax liabilities. Now, to be clear right out of the gate, we're not going to be talking about surface-level tips on how to run an Airbnb. Instead, we are treating this as an analytical engine. We're going to dissect the strict legislative mechanisms, the implicit assumptions, and the hidden cause and effect relationships of the 2026 short-term rental tax provisions. We're looking at the actual architecture of the tax code operating behind the scenes to shield W-2 and 1099 income.
So you might be wondering, how exactly do high-income earners legally erase their active tax liabilities using real estate? Well, the core problem for high W-2 and 1099 earners, doctors, consultants, engineers, is that your active wages are heavily taxed, usually at the absolute highest marginal rates. Now, the classic advice you always hear is to invest in real estate, right? But here's the catch. Standard passive real estate losses are legally restricted from offsetting your active income. The implicit assumption baked right into the tax code is that active wages and passive investments live in two entirely distinct universes. They are kept strictly separated. So the real analytical question is, how do financial experts actually bridge that gap to completely erase an active tax liability?
The foundational mechanism of this entire strategy relies entirely on engineering what's called a paper loss. And a paper loss is essentially just a mathematical deduction that shelters your income without actual cash ever leaving your bank account. The most powerful form of this, by far, is depreciation. See, the tax code acknowledges the physical reality that a building deteriorates over time. By capturing that deterioration as an immense expense on your tax return, your taxable income absolutely plummets. But, and this is the crucial part, your actual bank account balance remains completely untouched. In fact, it's probably growing from the rental revenue coming in.
Okay, let's look at our roadmap. We're going to systematically deconstruct this by looking at 1. The active income tax shield. 2. 2026 bonus depreciation rules. 3. Leveraging cost segregation studies. 4. The short-term rental workaround. And 5. Strategic execution and compliance. Let's dive in.
Section 1. The active income tax shield. Let's look at overcoming the standard hurdle. Historically, if you wanted to use real estate losses against your active W-2 income, you needed something called Real Estate Professional Status, or REPS for short. But just look at those requirements on the left. 750 hours a year, and more than 50% of your total working time dedicated strictly to real estate. If you have a demanding full-time job, you'd basically need a time machine to legally claim this. It is mathematically almost impossible. But look over on the right. The short-term rental rule requires just 100 hours a year and an average stay of 7 days or less. This is the highly accessible workaround that completely bypasses that massive REPS barrier.
Moving on to Section 2, 2026 bonus depreciation rules. This is the legislative catalyst.
100%. According to the tax models in this expert report, with the latest legislative acts effective in 2026, bonus depreciation has been completely restored to 100%. And guys, this is an incredible catalyst. Why? Because bonus depreciation was actually previously scheduled to phase out entirely by 2027. It was dropping, and dropping fast. Its restoration to 100% introduces a massive compounding advantage. Instead of slowly trickling your tax deductions out over nearly 3 decades, where, let's be honest, inflation just eats away at their true value, you can take an immense portion of that paper loss entirely in year 1. It's a remarkably powerful use-it-or-lose-it mechanism.
But the crucial detail to understand here is exactly what qualifies for this. You cannot just write off the entire building structure in year 1. No way. The implicit rule is that only specific property components, specifically those with a depreciation timeline of 20 years or less, qualify for this immediate full value write-off. The structural building itself remains rigidly stuck on a 27.5-year timeline. So the analytical puzzle we have to solve is, How do we mathematically and legally slice up a house into different timelines to isolate those 20-year components?
That brings us to Section 3, leveraging cost segregation studies. This is the accelerator.
To answer that puzzle, financial experts leverage a brilliant engineering mechanism known as a cost segregation study. Now, this isn't just an accountant sitting at a desk crunching numbers. An engineer literally goes in and mathematically dissects the physical property. They inspect and strip specific physical components, things like your appliances, specialty lighting, carpeting, landscaping, cabinetry. They strip all of that away from that long 27.5-year structural timeline. By reassigning them to 5-year or 15-year accelerated schedules, these components suddenly fall strictly under the 20-year threshold. They instantly become fully eligible for that 100% bonus depreciation, which accelerates literally decades of tax deductions right into your very first year of ownership.
Let's actually map out the cause and effect relationship here, because this is where the magic happens. Look at these numbers. Under standard depreciation, you might have an $8,000 net cash flow, a small $3,000 paper loss, and you still end up paying taxes on $5,000 of income. But if you apply a cost segregation study combined with 100% bonus depreciation, your actual net cash flow in the bank is identically positive. It is still $8,000. However, your paper loss absolutely skyrockets to negative $30,000 or more. So your taxable income drops to negative $22,000. You've just created a weaponized tax shield, all while the actual cash in your bank account grew. It's wild, but it's completely legal math.
Section 4, the short-term rental workaround. Here is how we connect this to your active income.
The very first strict actionable threshold you have to hit to connect this massive paper loss to your W-2 is the number 7. The average stay of your guests must be strictly 7 days or fewer across the entire tax year. The implicit assumption of the IRS here is actually pretty fascinating. They view transient lodging with stays this short not as a passive real estate investment, but as an active hospitality business. And that legal distinction right there, that is the vital linchpin of this entire strategy.
The second threshold you absolutely must hit is 100. You must clearly document at least 100 hours of material participation in managing the property over the year. Furthermore, and listen closely, because if you are executing this, you really need to pay attention to this non-obvious operational trap. Your 100 hours must be more time than any other single individual spends on the property. If your cleaning staff logs 110 hours and you log 105, boom, your tax shield completely collapses. You have to meticulously track activities like guest communication, coordinating maintenance, and optimizing pricing to satisfy this rigorous test and make sure you beat out any of your contractors.
The underlying mechanism at play here is that passing these two specific tests legally reclassifies the rental from a passive activity into an active business. Now, the 1986 Tax Reform Act famously built this massive legislative wall specifically designed to stop high-income professionals from using rental losses to offset active wages. It was literally created to end exactly this type of deduction. But by meeting those 7-day and 100-hour rules, you legally bypass that wall entirely. That massive paper loss we just engineered can now be subtracted directly from your highly taxed W-2 or 1099 active income, erasing a huge portion of your tax liability.
Section 5, Strategic Execution and Compliance. Let's talk about applying the framework in the real world.
The execution process here demands proper sequencing. You absolutely cannot skip steps. The process is strictly linear based on cause and effect. First, you acquire the asset. Second, you hire the engineers to conduct the cost segregation study to accelerate that depreciation. Third, you rigidly document your 100 hours of participation before the year ends. Only then, at step 4, can you explicitly apply the offset to your active income. If you fail to rigidly document the hours before applying the offset, the entire structure will just fall apart under audit.
And here is a critical compliance detail highlighted in the expert analysis regarding exactly how this gets reported. You must ensure the asset is filed accurately on your Schedule E.
but it has to be explicitly documented as a short-term rental with active material participation. See, tax software just naturally defaults to treating Schedule E properties as passive. You have to actively force the software to recognize your material participation. If you miss this, the automatic IRS algorithms will instantly flag it as a standard passive long-term rental, and they'll disallow your offset. It is literally a tiny checkbox, but it has massive financial consequences.
This quote right here perfectly synthesizes our entire analysis today. The true financial engine of this tier of real estate investing is not the monthly rent check. I mean, the rent check is nice, sure, but it's really just what keeps the asset stable and pays the mortgage. The accelerated tax shield, the depreciation, operating silently behind the scenes, effectively rerouting money that would have gone straight to the IRS back into your own pocket, that is what truly accelerates wealth.
As we wrap up this explainer, I want you to ask yourself if your current financial framework is effectively utilizing these precise, powerful mechanisms. Are you just playing the surface-level game of simple cash flow, or are you actually engineering the underlying architecture of the tax code to strategically eliminate your active tax burden? Understanding the deep cause and effect relationship between property classification, cost segregation, and active income limits is what really separates standard investing from expert analytical tax strategy. Thank you so much for joining me for this deep dive. Keep learning, keep structuring, and we'll see you in the next explainer.